I have the full deduction, full wording on the disclosures here, and I do want to make you aware that the Option Ranger calculator is an all markets calculator, so you can model stocks and stock option transactions and combinations. So that has been input, and you can do either basic strategies under the basic stock option calculator, or you can do advanced stock strategies with our stock spread option calculator. And likewise, there are basic future strategies as well as spread future strategies that you can use and that you can model. Bear in mind that this is not individualized trading advice. So as an example today, we are going to be doing a session on short strangles, which is a volatility play in the markets, and we'll go over the basics. And again, short strangles are margin trades. So while we are modeling them today, some people are suitable to do margin trades and others are not. So you should definitely take inventory of your own financial situation, your own risk tolerance, and make sure that the trades that you are modeling in terms of the numbers are also suitable for you and your financial objectives. The first thing I'm going to do now is take you to our strategy gallery where a lot of the trades get selected, and take you to the strategy under which, to the scenario under which a short strangle would be used. First of all, as a refresher, we are set up for the two principal factors in selecting a trade and a strategy. One of them, which most people think about, is direction. Is the market going up? Is it going down? Or is it going sideways? When you have a scenario, many people have an opinion of direction, and they only look at this category. Another key variable, especially when using options or spreads or looking for non-directional trades or for more finessed outlook of what's going to happen, is to look at a very key ingredient, which, and I cannot overstate the importance of understanding this, which is the volatility outlook. So just the way a person can think that the market can go up, or has an opinion that it might go up, or it might go down, or it might go sideways, in order to put together a trade, you should make an effort, a serious effort, to also have a volatility outlook, which means, do I think that the market is going to get more or less volatile? Are things going to get crazy, hectic, along with my directional change, or are they going to get more quiet? By combining these two outlooks, you have a more complete basis to develop a strategy and an opinion. The particular strategy at which we are looking today is one that, interestingly enough, has no directional outlook. This is for people who don't really have an opinion that the market's going up or down. And the only, in fact, it goes along with an opinion that the market's going to go sideways. And as a principal ingredient in selecting this trade, more so than direction, is simply the outlook that the volatility in the market's going to fall. So that whatever has been going on in a given trade, you think that it's going to quiet down. If you think the market's going to go sideways and quiet down, then this is a trade to which you would go. And just to go very briefly, so you see how our strategy gallery works. When you get the short strangle trade as an opinion, you have a summary just to make sure that this is your outlook. So whether you look at it before or after you decide to evaluate a trade, here it is. You feel the market appears to be calm, or will become calmer, trade in a narrow range, volatility is going down. Your profit, this is a credit trade, which means that you're going to be collecting premium, expecting lower volatility. So the most you can make, The most you can make in this trade is the premium that you collect. You're playing insurance company. You're collecting premium from people, anticipating that certain events will not materialize. And the bread and butter of this trade, what makes it work, is time decay, time erosion. Anybody that has bought options and lost knows that even if your direction is correct when you buy an option, but the volatility is wrong, time decay can turn a winning directional outlook on an option into a losing trade. So here, your principal friend and what you are depending on is time decay. The loss potential, as you can see, while the profit is limited to the premium that you collected, this is a margin trade. So if you are wrong and the market makes a large move against you, then you are incurring all the risks and responsibilities that are associated with margin. If you are not a margin person, this is not a trade for you. On the other hand, there are ways of adapting this trade where instead of having a marginable short strangle, you can have a covered premium collection strategy. This will reduce your profit potential, but conversely will also reduce your risk level or the unlimited risk, and we'll get into that later. But today we're going to go straight into the short strangles that were discussed. So let me pull up our master combination calculator. And for the sake of seeing some of these illustrations, we're not going to do a lengthy example of inputting the trade so that you can see as much as possible, be exposed as much as possible. I've actually saved some trades here that we can look at, and if you want to learn how to input these trades or change the values, please set yourself up with your own username and password. We'll be happy to help you. And you can also look at the demo videos that we have in our reference materials. Great news, we'll be adding some demo videos through the balance of the week and into the weekend so that you will have even more backup tools to go ahead and practice entering trades and analyzing trades on your own. What I did here, and again it's something you can customize on your own, when we created this short strangles tab, you can word it any way you like, or we can. So in this case, we actually put in the words that we have a volatility downward expectation and a direction none. And just as a reminder, I put the word margin there. You can word your tab with whatever strong words or reminders you need. And if you want us to set up your tab set for monitoring, then we'll do that with you. So let's go right to it and have a look at a market that a lot of people like to strangle because of the premiums and the liquidity. And of course, we're talking about the S&P 500. The first example that we're going to show is on the large contract. Again, as you know, when we input a trade, the dialog boxes would help show up. So in this case, you get all the contract specs and the specifics on the contract. And if you want to see them in greater detail, inside this help box, the dialog box, there's one more link. And that link takes you to all the contract specs, fundamental news, and what you need to monitor when trading this market. You'll see that under our tabs, or if you want to go to one of our previous demos. But let's go straight to an example. So once we input this trade, it consists, as we saw previously in the strategy gallery, under dynamic option strategies, we had a description. Now we go straight to it. We're selling a call, and we're selling a put. In this particular case, strictly for illustration purposes, the sale was a 1900 call. The market right now, this is in March, so the market presently is trading around 1825, so this is 75 S&P points up. You have to watch the expirations so that you know when that is. We are looking at a trade that has, so we'll get that in a few minutes, how many days to go. You'll see that in our contract spec section. And on the put side, The sale here was of a 1650 put, again with the market at 1825. This is 175 points away on a drop. As you can see, there's the skew in these options. The calls, which are only, well, it's a pretty big move if you think about it, 75 points away, we're trading around 280. I guess about an hour or two when I set this up, or two ago when I set this up. The puts, which are 175 points away, are trading for nearly the same price. This is a volatility skew. It shows that there's still a decent amount of fear in the market on a drop, and that's why a premium, a pretty significant premium, is commanded here. People scared of a drop might be overpaying for this put because they're worried, so fear is a great motivator, whereas people who want the right to buy the S&P at 1900 may think, wow, this is a pretty big move. So clearly fear of a drop in this case is creating a volatility skew as the motivation for the buyers of those options. And you can look at various scenarios and we can discuss them, but this is an interesting thing that you want to review when you are selecting your trades. And obviously you can change these strike prices based on your outlook. So let's look at the trade. We're collecting 700 plus 675. This is on the large contract. So the net credit is 1375. That's what you're collecting because you're selling premium. Afterwards, remember, as with any transaction, we want to input our costs. So this defaulted to a cost, I believe, of just 35. So you take out all those around turns. So your net on this that you will be collecting if you put on this trade is 1305. The summary box shows your break-even point on the futures and your break-even point on the premium, both on a downside move. So you basically intrinsically would be losing money under 1645. 1644.78 to be exact, and on a rally your high break-even point again would be above 1905. Your premium break-even, and that's what you monitor all the time, you go online, be sure to be set up with your live quotes, and you can ask your broker or a trading desk or go online directly. Your break-even on this is 5.22 in premium. We translate it so that you know if you can buy this position back for 1 point, you're in the clear. If you have to spend more than 5.22 to buy it back, that means that you are beginning to give, not just to give back money, but to incur losses. The sweet spot of this trade, and it gives you what would be, obviously you have to do it is to believe that the market will end up in this range, is to keep your entire premium between, let's say, obviously at 1650, you keep your entire premium all the way up to 1900, which are the two strike prices that you sold. As long as the market stays in that range, then on expiration you will keep the entire net premium that you collected, the net premium after costs, which would be 1,305. This is a margin trade, however. So if for some reason the market breaks out of this range, your losses are unlimited out of this range, and you would, and the person who does a short strangle would be risking $25 per tick on a move above and below the places where we collected our next credit. So you have, if anybody has a legitimate concern that the market can break out significantly and suddenly, with rising volatility, below the 1650 and above that 1900, this trade would be one to question. On the other hand, if the market with time erosion marches slowly in either direction with falling volatility, we could say, well, I'm really worried about a drop, but we can go from 1825, let's say, to 1725. And as long as the move is slow, not with high volatility, this market could creep down 100 points, and if by expiration it didn't drop down hard enough, although there was a direction, it wouldn't be volatile enough, and even at 17.25 at expiration, you get to keep the premium. If the market, however, starts moving down quickly and you find yourself at 1750, 1725, 1700, and it's not expiration day, then you might have to reconsider and have a follow-up strategy to offset or reduce risk. Likewise, on the upside, as you can see, if the market unexpectedly and with rising volatility breaks out, as you can see, the losses can become pretty severe. So if you can think of a reason why the market in, let's say, the next 20 days can find its way to 1900 or 1925 or 1950, then this is not a trade that you would want to put on. The key to doing short strangles like this is to make sure that you know where your ranges are, where your premiums are, where your risk is, and to monitor closely and be very ready to make adjustments and be nimble. Now, for folks that don't want to take the full risk of the large contract, as we indicated previously, there is a smaller S&P contract, the E-mini contract. The options on it are very liquid. I use the same strike prices just for illustration. Again, it's a trade where after commissions you might end up with a credit of only 245. It's in the same range, which I consider a pretty big range. But if the market breaks down terribly or rallies like crazy with rising volatility, just as your credit is smaller because it's a smaller contract with less leverage, your losses are also smaller and your risk is smaller. So as with most cases, if you see a pretty good size reward, there's probably a good size risk, and the only way to bring that in balance is usually they're flip sides of the same coin. Let's look at another market now again, and the way you make these decisions in many cases by looking at a chart. So let's first of all look at a crude oil trade. Okay, and here we've got a selection here, and let's look at the factors in the trade. Again, it's a short strangle. The tick value is 1,000 barrels. We sell, and this is basis May. This is basis May. Prices maybe about an hour ago, 2 hours ago. The 107 call. May is presently at 99.27, so just a little over 99. The 107 call is 50 points or $500. And the 88 put is 42. So when we want to calculate that, we're going to say, yeah, but how much do we get? What is our risk? Where do we make money? Where do we lose money? Again, in this case, you have the details of the trade, premium collected, total difference. Obviously, you want to input your costs so that you have a net based on this structure of $830. When you put this trade on with these costs, you would be collecting, under this scenario, a net credit of $830. Your premium break-even would be 0.83. So when you get quotes on this position, again, because you collected money, you would have to pay less than this. So if you see your costs go down to 20 or 30 or 15, whatever your number is, you would know that you collected more than that here, so you could buy back and offset the position at a profit, looking at premium, which is what you need to monitor. The break-even point on the futures, which is on intrinsic value, is at 87.17 on the put side. So at expiration, you would need the market to be above 87.17 to make money because of what you've collected. And it would need to be below 107.83. So essentially, if you feel like this market might go up, it might go down, it might go sideways, but it's going to be tame enough to stay in this $10 range, and we're talking about a $10 range. If it's roughly $5 on each side, you've got that kind of a cushion and are comfortable with that and the margin, then this is a trade you could consider. Again, remember, the risk, because it's a margin trade, is unlimited. So once the market breaks to the downside or breaks to the upside with rising volatility, intrinsically above the 107.83, below the 87.17, the transaction would be losing $10 per tick move. Now again, unless there's a sudden move, a wise option writer, if the market is trending or seems to be picking up volatility, will offset a position if possible before that materializes. And again, as you can see here, we've got our sweet spot essentially between 88 and 106. And our break-evens are a little better than that. And of course, if you think that the market could suddenly drop to 80, this is not a trade for you. If you're thinking suddenly drop below 80 or to any of these numbers, as you can see on a huge volatile, increasing volatility move, this trade can incur significant losses both on a drop and on a rally. For people who can't incur this kind of margin risk, but they want to still be on the premium collection side, you can look at covering strategies on both sides. Now, the way to come up with this trade, and there are a lot of analysts, there are a lot of directional people. You can talk to our APs who have opinions, or various APs, or subscribe to different services. When we come up with this trade, whatever the strategy is, the premise again is lower volatility, a trading range between a set of numbers, and one of the reasons this trade is attractive to people is because when you write these options, they are mutually exclusive. So the bet here is basically that the market can't be above 107 and below 88 at the same time. Even if one trade goes against you, let's say for instance the market rallies to 107 or close to it, the 88 put that was sold obviously can also be in trouble at the same time. So if a market runs one way, at least one of these will expire worthless, and ideally you would want both of these to expire worthless. That is the importance, and that is the reason why people sell premium. They're getting a margin error, they're getting a cushion, they're selling mutually exclusive options, and all of these advantages are for people that are well-heeled and on top of the markets that are prepared to take the margin risk in order to have the advantages of time erosion and on their side, along with a cushion between the strike prices. Finally, and again, let's say for instance you're looking at crude oil and you're thinking, well, let me just remember some of the fundamentals and what do I need to monitor this market so it doesn't go crazy. When you can click on complete contract specs, you go to crude oil, you not only get the complete contract specs, but you get what you need to watch while you're in the trade. So you want to make sure that you have some notion of what's going on with the API report on Wednesdays, the Department of Energy, Commitment of Traders report. So while many people don't monitor all these factors, this is a list that we have compiled over better than 15 years of things that we like to monitor and we believe should be monitored, not just before deciding on a trade, but also subsequent to putting on a trade, to know whether or not something is coming up that could either benefit your position or hurt your position, and be informed. Sometimes if there's a big report coming up and you're in profits in a trade, you can just come out. If you're uneasy about a given report, then you can offset a position. So it's good to at least know what that is. One of my favorite sayings in trading, and I think everybody should have this version of this, is he who fights and runs away lives to fight another day. If you have a big report coming up and you have a position ahead of that report and you have any discomfort or nervousness, you can always flatten the position and consider reinstating it after the fact. Again, it's a matter of personal disposition. It's something that you have to work out on your suitability. The next example that we've used here is on the silver market. And there's a lot of volatility and excitement in silver. So let me go ahead and show you one example on this market as well. Again, we're not recommending any of these trades. We are just trying to show how these trades can work, and on analysis, how you input them, and how you can decide whether or not they're right for you.
We have a question before you move on.
Okay.
To control risk, what if you bought a put below the short put and bought a call above the short call? Can you still make money?
That is an excellent question, and that is an actual strategy. What we're talking about here is an iron condor, and the strategy actually appears, believe it or not, in our dynamic option strategy section, because this is really a scenario for falling volatility, and here it is, as you can see. So you can actually model out this trade, and in both cases, whether it's a short condor or a long condor, it has these four legs that were just questioned. The strategy, what that strategy accomplishes, and let me just go back for a moment to our current calculator. When you do that, basically you do two things. Number one, you are capping your risk. The put that you buy underneath and the call that you buy on top are basically going to give you a level of predetermined and limited losses, because you are essentially reinsuring or transferring risk to the next person. The plus to that is now you can have the strength and the advantages of time erosion and collecting premium on your side without the unlimited risk. The disadvantage is that obviously when you buy a call and you buy a put, you spend some money, so that the premium that you've collected, your maximum profit, now goes down because it costs you some money to reinsure or cover your options, or to protect your options. So as with everything, there's a trade-off. The trade-off is your profit potential goes down, but the advantage is that you no longer are sitting on a trade that has unlimited or margin risk. We are actually going to model some of these trades later on, and you can easily do the math on this, because all you need to do is just see what call and put you buy, see how much they cost. It reduces your profit potential by that much, but it caps your risk at the places where you paid the premium. When you go into the strategy gallery again, you will be able to see these strategies mapped out with a profit and loss scenario. When you do iron condors and multi-leg trades like this, because you are spending additional money for the options you buy, and you are reducing your bottom line when putting on the trade, it's really wise, number one, to still have an adjustment strategy if the market becomes increasingly volatile, because just being covered doesn't mean that if you want to incur the maximum risk if you can adjust and be alert. Number one, so be sure that you are still monitoring those trades, and secondly, be mindful of costs, because the third difference between a short strangle and an iron condor is that instead of doing 2 transactions, you are doing 4 transactions. So your transaction costs have to be reasonable, so that doing 4 legs on a trade serves your purposes as well and is still within the cost parameters that you need. And again, that's why the option ranger, in the option ranger, we're very particular about inputting trades. Just to give you an example of the importance of monitoring this, if somebody tries to calculate a trade and they forget to input the costs and they try to do a calculation, you immediately get an error message, because we want to make sure that people factor all those things. Secondly, let me just put in some sort of a default price here. Secondly, I want to show you something very interesting. If you input things wrong, so let's say, for argument's sake, you put things in reverse. Let's say you put in a 1600 put, a 1600 call, and you write them backwards. Instead of doing those numbers, you just input. You're in a hurry, you try to do a calculation, you got a short strangle here, and then you input the calculate button. Notice again, we have a fail-safe in the program in which you will be reminded that the entry was wrong, that on a short strangle the call price has to be higher than the put price, so that you can avoid some of these careless mistakes. By the way, for everybody in our beta group, it's very important to point out to us any item, either that has a glitch in it or anything that you would suggest that we do with the software. Anybody who finds any sort of a mistake or a correction, I want to give you all a bonus. We'll get an additional free month on the software and all of the perks after the beta period is over for helping us find something wrong. We love compliments, but what really helps us is folks with a keen eye who are going to point out anything that we may have missed. And again, that last thing that we just showed, which corrects a trades if one of the inputs are wrong, that is the type of feedback that we want from all our participants. So now we have just completed the 4 examples on a short strangle that we wanted to do today. We encourage you, if you have any questions on the follow-up strategy, if you want other short strangles to be modeled, or if you want to do a separate section or separate analysis with your coach or with somebody that is presently helping you with the tabs, be sure to bring up the idea of covered options. And in fact, you can find those again just so you are familiar with our structure. When you go to the strategy gallery, you can click on the strategy gallery, and you can see those types of trades in several categories. You can see the condors at the end. Okay, and again, if you have a bearish or a bullish outlook, you have 2 different kinds of, both. There are different kinds of long and short condors that you can do. You can look at those and you can model them out. If you want to do one particular leg on a trade, you can look at for instance, a bear put spread, which consists of collecting more premium than you spend. A bull put spread and a bear call spread. Both of those are going to be trades that are in the diminishing volatility category, and it's a place where you can model out some of the values. Remember also, you can just do one leg. So let's go back to our recent trade in the strategy gallery, in the master combination calculator under saved tabs. And let's say, for instance, you were doing one of these trades, and let's go to the example of the crude oil. Okay, and I'm just going to make up this, not an actual scenario, but I just want to use it for purposes of illustration. So let's say somebody says, you know what, I'm really happy that the market's going to stay between these 2 levels. It's going to be below 107 and below 88. And I'm really happy to collect 42 points, $420 on the put and $500 on the call. However, while this person may not be extremely concerned about the market going down a lot, they're saying it's a great trade, but what if something happens in the Middle East? What if Iran does something? What if something happens in Saudi Arabia? A person like that can adapt this trade in a very simple trade. They can say, let me go ahead and sell this put for 42, and I'm willing to leave it naked, understanding the risk. But just in case something crazy happens, I paid $50. I collected $50 minus costs for this. Let me go ahead, and instead of trying to keep the whole 500 or whatever the number is, let me reinvest a couple hundred just in case the market flies to the moon and buy another call farther out of the money. So this way your net credit will be smaller. You're still going to have a naked option on the bottom where maybe you have less concerns, but on the 107 call on top, which you may be reluctant to sell if you have anxiety about the Middle East, you might say, you know what, I'll reduce my gains, my low volatility expectations, because I still have that tiny fear of hugely rising unexpected volatility, so I will reinvest to cover the call, and then these numbers will change. So let's say, for argument's sake, if you buy a 110 call for whatever, I'll make up a number, 15 points or 20 points, then that would reduce your profit potential here, but it will also cap your risk levels here on a big upside event. So as with anything else, you give up some of your profit, but you also mitigate some of your risk, and that's the importance of seeing things in writing, of modeling things out intelligently, so that when you see things in front of you, you see the reality of the risk, you see where the potential for profit is, and as many people say, seeing is believing. What we also know is that seeing is learning, because most people are visual, they're visual learners, and understanding the reality of a situation while looking at the numbers is much more impactful on your thinking process and your reasoning than just imagining an outcome. So this brings with it the discipline that we need in order to look at trades objectively, gets rid of wishful thinking in some cases. In some cases it defines fear in a way that it becomes rational, and people can look at numbers to make decisions. So again, remember, when you look at a trade like this, if you have a question, you can email that trade to a friend or to your broker, whoever that may be, or to somebody for an opinion. You can print it, as I often like to do myself, so I can mark up the trades and stick them next to a chart. You can save it under a Customize tab, and you see we have multiple tabs here of different types of trades that people can look at, and that we have saved for comparison purposes longer term. And finally, you can take one of these trades and post it to a forum. So if you have a great idea or you have a thought and you want some feedback, you can either email that to somebody that you're consulting with, you can post it to a forum to get some other opinions, and obviously you can also get trades and opinions from other folks. We can set up your tabs under different categories so you can look at trades as they come along. Are there any other further questions?
Not on the subject now.
Okay, outstanding. Again, please be on the lookout for under our reference materials. We're going to have additional demo videos coming out. If you haven't viewed them, please do. If you haven't tried to work yourself with the Option Ranger, be sure to set up a username and password, and don't hesitate to contact the number provided if you would like some help setting up your own homepage and your own tabs. That's what we're presently doing with our beta group under our licensing agreement, and we're looking for as much participation and feedback as you all can provide. So I want to congratulate you for taking the time to educate yourself. I think being a wise financial consumer and knowing about all the instruments that are out there is more important than ever. As we get into shaky times, geopolitically, globally, markets are up, stock markets are at lofty levels, yields are low, bonds are high. I think that people have to begin to understand how to be nimble and flexible, how to be non-directional, how to use volatility as well as direction to find a way to get an alpha edge, to outperform the markets out there. And the first step towards accomplishing that is being well informed and having all the tools necessary to be an informed trader. Again, we look forward to working with you and congratulate you for attending, and thank you for your interest.
Thank you, Mr.
Have a
Ray.
great day.